Welcome to Wealth Unfiltered, your go-to source for industry insights and wealth creation. Stay ahead of the curve with a thorough breakdown of market trends, financial developments, and the impact of current events on your wealth building strategy. We deliver the latest updates and essential insights into the financial world through expert interviews and detailed analysis. Welcome to Wealth Unfiltered. This is our new episode for you, From Headlines to Bottom Lines. So in this episode, we're going to be talking about what we're seeing in the market currently. As you all know, last week was the big presidential election. I think it's probably what's most top of mind to most people. But for us, this episode really is about how we see the market changing and what to expect in the upcoming year now that we're going to have a transition in our presidency. So I guess first, before I get started asking you any questions, do you want to start with the hot take and then we can move from there?
Yeah, and I don't think it's a hot take as much as it's something that I was taught pretty early on, and I think it really is coming to light, and it's going to be kind of one of the themes in what we're talking about, what's going on right now. And really, what I want everyone to remember is that financial markets, really, everything that we encounter kind of revolves around human nature. And the way it was defined to me very brashly, I was like 8 years old, was human nature is really like a ratio between fear and greed. And most things can be broken down into those two things. And I think
fear and greed.
Fear and greed.
Okay.
And I think that as we talk about...
And who taught you this?
My dad.
Your dad. Okay.
Yeah. So, I mean, there's other things in the world, but if you really look at a lot of things, and you look at how people
like
forecast
the human response,
the things that are most easily relied upon are what people are going to do out of fear and what people are going to do out of, you can call it greed, you can call it,
like necessity.
Yeah. But a lot of things, if you can figure out where you think that's going to go, you'll be pretty close to trends.
Awesome. Wonderful. So what is your take based off of that?
No, I mean, I think, we'll talk about it. It's going to permeate through the entire conversation.
Okay. So you're basically setting our theme.
Correct.
Okay. I love that. Okay. So I have some questions that I've prepared that I feel like will really help our audience with probably things that they're all thinking right now. One thing that I think we can all say is that fear has run probably pretty rampant because no one knows what to expect. They didn't know what to expect no matter which candidate became our president, right? Even though Kamala was a part of the Biden administration, she was running on a different platform in a different direction. And obviously we've had Trump before, but we knew that Trump is going to be a little bit different than he was prior. He's going to have a brand new cabinet. So I think no matter what person was going to become our president, I think fear was like across the board. I think didn't matter the party. People were nervous. They were scared. And I think that hasn't changed much only because people are actively still curious as to what will happen. So specifically, in finance and the next year of like, what is that going to look like? How am I going to continue to create generational wealth for my family? How will my investments be impacted? What will the markets do based off of what they anticipate the economy change, how it might change? There's a lot of those questions being asked. I think if you flip on any news station across, doesn't matter, who's doing it, I would say that those questions are actively having economists come on board, people chatting about their opinions. So I would like to understand, based off of that, what initial reactions have you seen currently? And A, do you agree with them? Do you not agree with them? And B, how do you think that will, maybe the reactions you're seeing, will they actually come to light?
Yeah, and I think one of the important things to just kind of define and to talk about early on is when you're talking about financial markets, when you're talking about, treasury yields and what the Dow Jones or the NASDAQ are doing, a lot of these things are going to be based off of human nature and its sentiment and its forecasting. So I think most people coming up into the election, I think most people thought it was going to be closer than it was. This isn't a political show. We're not going to talk about who should have won, who the right person would have been. More or less just try to figure out, now that we have an answer, like what are the expectations and how do you set yourself up for success? I think that a lot of people saw what happened over the last 6 months with, if you follow the Fed and you follow the easing of their federal funds rate, they tightened it, really impacts multifamily. quite a bit.
Absolutely.
Because there's less purchasing power out there. Cap rates have expanded, which means that prices are falling down, which poses a great opportunity for sponsors like Viking to get great deals. What most people thought was the Fed was going to do what it set out to do, which is lower the federal funds rate. And every time it was going to have an impact on the treasuries. The important treasuries that relate to our business at Viking Capital are the 5-year, the 2-year, and the 10-year treasuries.
Right.
If you're structuring a 5-year loan through one of the agencies, that's the treasury that's going to set your interest rate.
And can you just define that real quick? When you say agencies, some people may not know what
so
it means.
Freddie Mac and Fannie Mae, the U.S. agencies that provide loans, and they're typically seen as the safest loans and the more regulated loans. So if somebody's using one of those loans, they have to go through quite a bit of scrutiny with the agencies in order to be able to achieve structuring that loan. So most people would say if you're working with a debt fund or if you're working with an agency, I feel more comfortable if you've passed the test with the agency, they've done a level of due diligence that maybe I don't have to do as much due diligence if you've already passed that test.
It helps with kind of risk tolerance.
It helps with kind of risk tolerance. They're also less onerous and less predatory. So a lot of these deals, when you're trying to evaluate the risk that you're taking, you're trying to figure out, how do I lose all my money? Right? Because it's human nature. I'm fearful. So if I'm going to invest this money, where's my floor? What has to happen in order for me to lose all my money? If you're working with a very predatory lender and they're the biggest investor in the deal, and you get behind from a DSCR perspective, debt service coverage ratio, so you as a sponsor aren't able to pay your mortgage, a predatory lender is going to take the property and wipe out all of your equity. So all of your investors lose everything. The sponsors lose all the money they have in the deal. And the bank performs on its covenant in the loan, which is to take the collateral. When you have something like COVID that happened, there were a lot of people that, due to an eviction moratorium, couldn't pay their debt service. Predatory lender might take that property and say, this is the agreement you made. We had a contract. The agencies, way different. Oh, we're not going to have you pay for 6 months. We're going to work with you. They're not built to take on that property. They're not hoping that you fail. They're hoping to work with you. They want to collect their interest. They want stability. And that's, the main reason why you tend to see, really strong sponsors with big track records that are on the agency's list of good sponsors to deal with, tend to stick with those unless they need, a more aggressive, like a development deal might need a variable rate construction loan that's not through one of the agencies. Or maybe you're structuring a $500 million skyrise acquisition and you have a much more complicated capital stack with a mezz piece or, something like that. But for the most part, it's pretty simple when you're acquiring multifamily. You're usually buying on either a 5 or a 7-year hold, depending on where you think you're going to time the market. If you're buying at the bottom of the market where cap rates are very expanded, you might want a 7 or a 10-year loan to give you more time to kind of have more flexibility on when you could exit the deal. And the goal would be that if you're buying it at expanded cap rate, you want to build in enough flexibility to where you can hold the property, increase NOI, force appreciate the property, and then have flexibility to exit when cap rates compress.
So explain, because we started this conversation, you were talking about the treasuries. I think that it ties right into what you're saying. So explain how the treasuries and what they're doing affect what you're talking about with the purchase price and all of that.
Right. So the foundation here is the Fed, with its federal funds rate, sets the overnight trading rate. And then all of the other treasuries kind of are based off of that rate and baking in the additional risk that you're taking by the longer term of the treasury. So in a logical world, a 2-year treasury, if your money's at risk for 2 years, you're going to get a different rate than if your money's risk at 10 years. That was why a year ago when the 2 and the 10-year were inverted, it was an odd situation where you were actually getting a premium to put your money in a longer treasury than a short-term treasury.
Oh, interesting. Okay.
As people are tracking this, and we're tracking this because we have properties that we'd like to exit that we haven't been able to exit because treasuries expanded. And because of that, cap rates have expanded and values are depressed. But at the same time, we're also buying properties. So it's a double-edged sword.
Right, absolutely.
When treasuries expand and the interest rates expand, you're paying a higher cost. But what sponsors who are trying to sell are doing, it's just like us. We don't want to sell the properties that we had planned to sell right now because we're going to get a significant haircut on the purchase price or the sales price. So now that we're in this cycle, the way we're looking at the market is if we can buy properties today and expanded cap rate and they cash flow, they make sense. We have a good debt service where there's not a ton of risk. These properties are really going to perform well if we can build in enough flexibility and sell them. So, but at the same time, we want to exit some properties. We want some relief on some deals that we might have bought with variable rate loans that we're trying to refinance or restructure. So most people followed what Jerome Powell, the Fed chair, had been saying, and they cut 50 basis points at the beginning of their tightening cycle. What ends up happening is every week there's new data that comes out. And that data comes out and it kind of changes the mindset of what the Fed's going to do. So even though they just cut 25 basis points, so now they've cut 75 basis points, the treasuries are actually going up. So that phenomenon, even though they're cutting, treasury yields are going up, what's happening is it's human nature at play. So why are treasuries going up if the Fed is continuing its cutting cycle?
Wait, so like I think a really important piece of exactly what you're talking about, because you tried to explain this to me the other day, is that when the rates are going down, when they're making these cuts, it's because they're trying to help our economy, correct?
So the Fed has a couple of tools. So they have their balance sheet and they have the federal funds rate.
Okay.
So the idea would be that what they can do, what they have is a dual mandate. And that dual mandate is they're supposed to encourage job creation and a strong economy.
Right.
Strong work.
So that is the purpose of why.
So that's one of their mandates. That would be, we want to promote a strong economy. And then their other mandate is to keep inflation in check.
Right.
So what happened when all of the spending through COVID, all of those checks that were mailed out, the quantitative easing that happened to kind of like kindling for the economy. Let's help people. Some people lost their job. They really sent out money to people that even didn't lose their job. Everyone got money.
Right.
So all of this extra money caused really high inflation. So once the Fed acknowledged that they created really high inflation with a funds rate at zero and all of this economic stimulus, they very quickly raised the federal funds rate to combat inflation. So what they're looking at every month when they have their FOMC meeting to decide if they're going to keep the rate the same, lower it, or increase it, is they're trying to see if we cut the rate, is this going to increase inflation? Or if we keep the rate too high for too long, is this going to cause the U.S. economy to start to be stifled and the workforce to fall?
Right.
So
wait, I don't want to interrupt you, but I also don't want you to go on too long, because I think the point that I wanted to bring to you that I think for the listeners important is that there is a juxtaposition of what you're saying with the treasuries versus the Fed. And I think basically the Fed cutting signals that they are trying to strengthen the economy. That's the reason why we've continued to cut.
Right.
But the inverse of that is what you're saying is going on with the Treasury, correct?
The Treasury has actually grown, and part of that is because of the politics.
Right.
So what ends up happening with the Treasury? So by the time the Fed is cutting rates, the Treasury has already listened to the meetings. They've already looked at what's going on, and everyone's trying to forecast. So the market will bake in what they think the Treasury is going to do well before they do it.
Okay.
And then if any data changes, the yields react. People buy, sell. And it's human nature that actually controls where the Treasury yields are. So same thing with the stock market. It's the same thing with things like Bitcoin.
That's what I was just going to say. So the 2 days prior to the election, we saw a huge fluctuation.
And if you noticed 4 months ago, 3 months ago, you saw a huge dip. You saw the 5-year Treasury down, trading at like 3.4. So really messes with a business. Like if we're trying to buy a property and we have a rate that we're planning on at a Treasury of 3.4, and then everyone feels like the economy is much stronger and the Treasuries shoot up to, I think today they're at 4.3, that could mean that the bank gives us a loan for $3 million less money. That might mean that the interest rate goes from a 4.8% interest rate with a buy down up to a 5.3% interest rate. And it dramatically affects the deal. Now, what is better for an investor? It really depends on how you're positioning yourself. So if you're somebody that was looking at buying a property 3 months ago, say even forget a company like Viking. If you were going to buy a home and you wanted the 30-year mortgage, where it was 60 days ago was much lower than where it is today. And we don't know where treasuries are going to go, or it's all going to be based off of new data that comes out. One of the things that happened even before we saw who was going to win the election was there was a really, really strong jobs number that came out.
Yeah.
And just because that one data point, all of the other data points showed a weakening economy, that data point came up much above what was expected. And from that moment on, you saw the Treasury start to go up. So like, oh, we got this wrong. A lot of people thought the Fed was going to cut another 50 basis points. They cut 25.
Right.
So even though they cut, because it wasn't as strong, because the economy doesn't seem as weak as originally thought, Treasury yields are reacting differently. So it's really hard to kind of forecast where yields are going to go because it's all based off of the human reaction to what they think is going to happen.
Right. So that actually brings me to my next question. So how do you think this election outcome, if that affects investor sentiment?
Right. I mean, I think what you've seen in all the markets is that people remember when Donald Trump was president in 2016.
Right.
Viking, the ability to syndicate capital, bonus depreciation, a lot of these were things that were introduced in the 2017 Jobs Act.
Yeah, 2017.
So he was elected in 2016 and then the following year put this in. So a lot of people are now starting to bake into the market that he is going to do the things that he promised to do. Will he? We don't know. But a lot of the things, if you're using revisionist history to what Trump did before, 100% bonus depreciation, where you can accelerate the depreciation in an asset that would usually take 30 years and take it in year one for a big, tax advantageous write-off on any passive income. One of the things that Kamala was campaigning on was, taxing unrealized gains. So like which
could have been detrimental to many investors.
It would have changed how people felt about investing and how they were placing capital for sure.
Right.
And I think that the way that it isn't my opinion, if you just look at what's happening prior to Trump getting elected, he went on a campaign about how important he thought Bitcoin was and how he was a supporter of Bitcoin.
Right.
Even though originally he wasn't a supporter. How does he really feel? Was it marketing? We talked in the last episode about marketing and positioning. A lot of that happens in an election.
I also don't know if this is true, but something I did see was that he and his family are creating some type of Bitcoin thing. So I'm sure once he realized he could get Bitcoin behind him even more, he's like, I'm going to go all in. He's a businessman. So he's like, how am I going to make more money off of this and use this as part of my
Yeah, I didn't see that. That's something I'll have to look into and kind of evaluate. But I think that to answer your question, the sentiment is that because Trump won, that the economy is going to be stronger. Most people felt if the inverse had happened and we woke up and Kamala was president, that the economy might be weaker and you might have seen the inverse happen. The treasuries dip back to where they were instead of shooting back up because Trump campaigned on deregulation. He campaigned on, favorable corporate tax rates and slashing the corporate tax rate even further from where he did 21% in his last term down to 15%. All of this pro-business deregulative environment is usually what you need for an environment to grow. Now, it isn't all sunshine and roses because I think what most rational people are thinking about is we were in a different time in 2017. In 2017, we weren't coming off a really high inflationary period. We hadn't spent all of this time trying to get inflation down. So is he really going to be as aggressive as he was then? Because what happens if we ignite the economy and then we have rampant inflation again?
Right.
And this is the conversation I have with the investors. I don't want investors to just say, hey, Chris, you're my financial advisor. Tell me which deal to get into. I want them to understand what educated guesses we're making based off of our experience, where we think cap rates are going to go, what they agree with, what they think is going to happen. Because I think that if you assume that inflation is going to get out of control again, guess what? The idea that the Fed is going to let inflation get out of control and not keep the funds rate where it is or increase it, they would have to if inflation got out of control.
Right. They wouldn't have a choice.
They wouldn't have a choice.
Right.
So I think it's too soon to tell. The market is reacting, and the market that's what the market does. It reacts. Everyone is greedy.
A quick question for what you're saying. The market reacts. Is this because this is something that I don't know if I've ever asked you before, and like I said, I'm novice when it comes to the finance world. But when you say market reactions, is that something that happens and you see a shift 2 weeks later and you'll see another reaction? Or is it more every month? Or is there a time frame where that reaction really stays kind of maintained?
Yeah, well, you have different dynamics within the different markets. So there's institutional investors, there's big institutions, there's insurance companies, there's also retail investors. So everyone's kind of playing a role. And when I say react, they're making sales or purchases one way or another,
Right.
based off of what they think is going to happen in the future. And a lot of this is based off now with technology, is based off of algorithms and AI. They're kind of trying to figure out, the name of the game is, if you knew the future, you could make the right decisions today.
Right.
So the people that have built tools and the ability to forecast really well are able to capitalize on markets before they really become really frothy and everybody knows about them. So,
what's your favorite quote you always use? It's about the
Baron Rothschild's quote.
Okay.
So the part of the quote that everyone's typically heard is, when there's blood in the streets, buy. And, the idea would be take 2021, 2022, where you saw, at least in multifamily, cap rates compress. So if you're buying at that time, you're buying at a really high basis, better deals now, but there's better deals because cap rates have expanded. Lots of those people that didn't protect themselves well might have lost a bunch of investor equity. They might have lost those deals to the bank.
To people who were skittish. They didn't want to invest.
Go even further, 2008.
Yeah.
If you started an investment firm like Viking in 2008 and 2009, 2010 happened, a lot of those people were wiped out.
Right.
They weren't able to recover from the blood in the streets. Now, if you look at companies that were started in between 2006 and 2009, that still exist today, those companies are huge and wildly successful. And the other part of that quote is, when there's blood in the streets, buy, even if it's your own.
Okay. Yeah.
And the point is that if you've faced some major adversity, these are cycles and they're cyclical. So if you're in the worst part of the cycle, chances are that there's going to be a rebound from that. And if you can keep your head above water, you could keep your investor money intact, and you can buy yourself time and the ability for the other side of the cycle to come in will usually heal all wounds.
Right. And that's the thing I was just saying. So people are skittish, right? So I think, just like we talked about, I love the way you put it, the kind of the theme of the show is reaction is based off of human nature. And a lot of people are I risked everything, I lost everything. Why on earth would I do it again? It's like that saying, fool me once, shame on you, fool me twice, shame on me. But instead of looking at it in that light, it needs to be more of you just said, there is going to be a recovery period. And if you're smart enough to see the indicators, I think that's maybe the biggest piece too that we maybe didn't touch on yet, is that there are very big signs and signals when you start to see recovery happen. And if you see multiple of those signals of recovery taking place, then that's your moment to start getting your ducks in a row, to start placing another investment, because you're coming across the other side of it, right?
Yeah, or you if you feel like you're at the bottom, you might not be at the bottom. So, a lot of people that are investing in deals right now are what happens if this was just a blip and tomorrow or 2026 is 2008.
Yeah.
And we were really in 2006, that area of the cycle. And I've invested in all this capital because I thought it was a great opportunity. I was it doesn't change. If you get 2 years down the road and that's really where the bottom is, you double down. If you believe and you've done your due diligence and you're working with rational structuring of investments, it's the same with Bitcoin. I don't understand all of the fundamentals of Bitcoin. It's not somewhere I have a ton of exposure, but I remember just a couple years ago, people took a bath in Bitcoin and it was down into the $17,000 a coin. Today it's at 90,000.
Right.
If you didn't sell your Bitcoin at 17,000 because you were fearful and you just held on to it, did nothing else, and just wallowed,
and not even buy more,
wallowed in all of the losses that you didn't realize because you still had the Bitcoin, now it's, almost 5x where it was just a few years ago. And
it's a great example.
Real estate is kind of the same thing. The stock market is the same thing. I remember in 2008, my father passed away in 2009. And with that being a very hard thing just in itself, part of my inheritance, one of the projects that me and my dad worked on since I was 10 years old was when he started investing in stocks. after he retired, he wanted to teach me how to evaluate companies. He wanted to teach me how to pick stocks and how to use direct investment programs and all sorts of things to build a portfolio over time. Well, I remember in 2006, that portfolio was worth a few $100,000. When he passed away and I inherited it, it was down to $48,000, $50,000. It had depressed massively. And had I sold all of those stocks thinking like, oh, like, man, what a waste. Like we did all of this stuff and sold it or let my greed and say, I'm going to go take this money and I'm going to buy a sports car. My dad's not here to tell me not to do the wrong thing.
Yeah.
You know, it would have been a huge mistake. But you hold on to those stocks and you look at them today and they're all worth massively more than they were even in the height of 2006. And the lesson, I think, is it's easy to say, buy low, sell high.
Yeah.
Right? It's easy to say that, but it's harder. Like, I'm not a gambler because I tend to lose when I gamble. And I don't like the feeling of losing. But when you're at the table, that's one of those areas where human nature really comes out. Like if you're winning a lot, you're greedy, you're willing to bet more. You start losing and you start seeing those losses. You want to protect yourself. And a lot of times it's like, I went out of this investment, give me my money back. I have no interest in doing this ever again. I've been burned by the fire. But a lot of times, and this goes back to something we talked about in our introductory episode. You asked me for, a lesson that I learned.
Right.
And what I said was, if something's worth doing, do it right. And what I was taught when I was first learning about investing from my dad was you don't blindly invest. Like if you're just picking a stock or letting someone else pick a stock for you, or you're picking an investment, Viking from some other company, without any due diligence or without understanding their business plan or who they are as people or how the company works, what has to happen, then you're not doing things the right way. And what did I say? If something's worth doing, it's worth doing it right. And that means learning how the company works. If you're going to invest in Coca-Cola, understand the business plan of Coca-Cola, read the prospectus, understand how everything works. And when you make a mistake or there's some major trend that adversely affects you, don't just say, shucks, I shouldn't have made that decision. Figure out why you thought it was a good decision and what you could have seen or noticed in order to have not made that decision.
I feel like that's like a really good way to, when you were talking about it, what I thought of was like buying a house. Like you don't go and just say, man, this house looks perfect. I want this house. Like they have to go in and your realtor will do due diligence on your behalf. They make sure that the structure and foundation don't have issues. Well, yeah, they don't have issues. You make sure, like there's also the wheeling and dealing of the purchase price. There's also the pieces of it, like how old is the AC? What is going to be like the deferred maintenance on the home? Like there's a lot of factors that you look into. It's not just, this is beautiful, I want it, I buy it. Like the shiny syndrome, right? Like, oh, this is amazing. But also when you purchase a home, you know that there are things that aren't going to go awry, right? So when inevitably your gas heater goes out or your AC, you don't just go, okay, well, it's time to sell my house now. I got to sell. We got to wash my hands out. I'm going to go find something new. No, you have to like continue to invest in your property, invest in your future, invest in your home. And you just have to look at it like that kind of.
Right. And if something goes wrong and it was totally unavoidable and it was just coincidence,
right,
then fine. Maybe that'll happen again, but maybe you'll be better prepared for something like that. You have a rainy day fund. You have money set aside in case something just goes wrong that you weren't expecting. But in a lot of cases, especially in business, hindsight is 20/20. And it's easy to look back and be like, oh man, like I can think of one example, with Viking in 2019, 2020, and 2021, most companies like Viking were using variable rate loans. And there was a really good reason and a really good logic in using a variable rate loan. And for the people that bought in 2015 and 2016 and 2017 and 2018 and sold in 2020 and 2021, they didn't see the negative effects of using short-term debt for a long-term. They timed it really, really well. And it looked like it was such a good opportunity because you were getting more proceeds than you'd get from an agency loan. You were protecting yourself with a rate cap. You had never seen an eviction moratorium before. The Fed had never raised rates 550 basis points in a 6-month period. So all of these things were things that were risks that could have gone wrong, but with none of them really have ever happening before. There was a historical context where you're like, you know what? If I use this loan and I hold the property for an extra year until rates get normal again, this is going to make a lot of sense. And I get much higher proceeds. My investors are getting a much better return. And for a lot of people, it worked out that way. For a lot of people that were buying into 2021 and 2022, when the Fed hiked those rates, it became a game of musical chairs. And, not everyone had a seat. Everyone goes, the music stops and it's like, oh, like, okay, I have a 2-year rate cap or I have a 3-year rate cap. And how quickly is it going to take for rates to come down to where you could refinance into long-term debt for what's now a long-term hold instead of like almost like a flipping opportunity. So when that happens and you're working with a sponsor, almost all of these sponsors are facing adversity, but the right thing to do, in my opinion, when you're an investor, is figuring out what the sponsor learned from that and what they've built into their business plans to make sure that they don't run into that problem again.
Right.
How they reported it to you as an investor. What did it feel like working with sponsor A versus sponsor B? And what kind of things did they implement to share in the burden along with their investor base? Because for all of those sponsors that, deals aren't going to pan out the way they thought, a lot of them, all that time and effort they spend is going to equate into zero profit at disposition as well. So these are all things that I think are important when you're forecasting and you're deciding who to work with. You have to look back and say, how was I treated? How was I reported to? Are they learning their lessons? What lessons can I take from this? And as we chart our way forward into better times, who is going to protect me when things get rough, when you face adversity? And that's ultimately...
And who can I still trust?
And who can I still trust?
So what you're talking now, we kind of pivoted a little bit to multifamily and syndications in particular. So with the election results, how do you think multifamily is really going to be impacted from President Trump taking over?
Yeah, I think it could manifest in a few different ways. I think a few of the low-hanging fruit are most people feel like the bonus depreciation aspects of the passive investments and reaping that tax advantageousness is going to get reauthorized either for another few years or permanently.
Because right now, bonus depreciation is on the phase out.
Correct. Part of the original 2017 Jobs Act was that it was going to go from 2017 until 2022. And then every year after 2022, it was going to phase out. So where you could take 100% of that depreciation you accelerated in 2022, in 2023, it was 80. Now we're in 2024, it's 60. Next year, it's
down to
40 and then 20, and then it's gone and supposedly gone forever. Middle of last year, there was bipartisan support and almost like a quid pro quo where liberals and conservatives came together. They wanted to pass a continuation of the child tax credit. Conservatives wanted a 5-year reauthorization of bonus depreciation in part of a broader bill. Very close to passing. Spoke with investors a lot about it. It was going to retroactively create a lot more tax passive losses that investors could use to offset other passive income that they had. It ended up not happening. And what I believe, I don't know if this is accurate or not, but what I believe is that we got so close to the election that the conservatives didn't want it to pass, and they thought that they could get a broader bill, a permanent bill, if Donald Trump was elected.
Right.
So this was one of the things that he championed. He's a real estate guy himself in his background, and it makes an abundance of sense for encouraging and igniting investment into real estate acquisitions.
I actually, a week ago, right? Actually, the day of the election, I posted a blog and it was bonus depreciation, how the election results shape investor strategies. And like through my research, so anytime I write a blog, I do a ton of research. And one of the things that, like what you're speaking to, is that, like you said, there has been a lot of bipartisan agreement when it comes to certain aspects of this, specifically the child tax credit piece, but kind of like marrying that with the bonus depreciation. But one thing that I was reading that I saw that would absolutely impact us was that the 100% would come back into play in 2026. So we would have another year of phase out, even through Trump taking over.
Yeah. And originally when I looked at the literature that was put on, from the government on the continuing resolution earlier this year, it was going to be retroactive. Will the new bill be retroactive? I don't know. So that will have to manifest. How the way that they write the bill and the way that they structure it will be really important. But in any event, I think, what I always tell people is a bird in hand is better than two in the bush. Like, don't bank on it coming back next year. You have access to 60% now if you have a lot of passive income.
Yeah, because you have to you have to do taxes either way.
Yeah. If you have a lot of passive income and you have investments that you like that are going to help grow your investment and offer you kind of a hedge against, passive income that you've taken in, or active income if you're an active real estate investor. Not everyone listening is someone that's going to invest passively. Some people follow the same strategy, buy duplexes, small multifamily, and they do a cost segregation study, and they use that against, active income because they're real estate professionals. So if that is the strategy that you're employing, utilize it while it's still around, because it's really powerful.
Awesome. And you said there was another aspect of how you
I think, what you'd have to ask yourself, what I ask myself is, if you believe that the tide is going to rise, and that means the economy is going to be stronger, people are going to have more money, people are going to spend more money, then you have to build in a certain amount of inflation. And interest rates might go up. That might create a buying opportunity. I am less bullish on interest rates coming down significantly with someone like Donald Trump, who it doesn't seem like there's going to be a lot less government spending. We'll see if his policies help him reduce the deficit. But if you believe that it could be an inflationary environment, even though it's bad in the sense that it raises the cost of goods, same thing with his tariffs, might raise temporarily the cost of goods as people are jockeying for their products to be sold, whether they're made in the US or made overseas. Investing in multifamily is one of the investments that is a hedge against high inflation. That was always one of the reasons why investing in multifamily during this highly inflationary time was a good idea, was because if inflation goes up, that means that the 3% rent growth that we had in our pro forma, you might be seeing 10% at the property level.
Right.
And even though there might be other dynamics where interest rates are going up and the cost to build a property is going up, if you're worried about inflation and you want to hedge against it, multifamily fits right in there. Whereas some of the other asset classes like retail, hospitality, what I ask myself when I'm looking at investments is like, do I want to invest in hospitality or retail? Now, maybe you're getting a better cap rate right now, and it's very, very high cap rate than where it has been historically. But what can disrupt the business plan? And high inflation would disrupt it. Because if I have less money, we as a family have less money, then our summer vacation might look different. Our winter vacation might look different. We might not stay in X hotel. We might try to pare things back. Same thing with retail. Retail is usually going to explode when times are good. When times aren't as good and you have a weaker economy and people have less money and less disposable income, retail gets affected quite a bit. Yeah. So the other piece that I've been reading a lot about, and it's kind of unique to this political battle, is Donald Trump ran on a platform of mass deportations, crazy amounts of immigration that he felt like needed to be corrected. And there have been lots of articles and lots of people feel like if this comes to fruition and he's able to do what he sets out to, that a lot of the labor that goes into building new multifamily could become more expensive, because a lot of developers, a lot of construction crews rely on unskilled labor that might be immigration based. And if all of those people are forced to hire citizens that fit under minimum wage laws and all of this type of stuff, that the cost of construction could go up. So it doesn't necessarily affect me acquiring a property that's already built. However, it does in the sense that when you're looking to acquire a property, one of the big components of assessing risk is what's the replacement cost. So
the other thing too, so that you're talking a lot about development is like kind of what you're inferring to. And so one of the things that, I actually had it in my notes was, how would the election impact supply chain? And that is also has to do with development, right?
Correct. Because one of the things that the president doesn't need support from, Congress and the Senate is with tariffs. And I think, the way that I personally believe that a lot of the rhetoric surrounding tariffs is a negotiation tactic to create better trade agreements. And I think that if you go back to 2016 to 2020, that's kind of how it was used. There's a lot of arguments to be made that if you put a bunch of tariffs on things that we import, that the cost definitely passes on to the consumer, and that's accurate.
Right.
Now, at the same time, what it forces you to do is if it's the same cost for something that was built in China, or it's less money for something that was built in America,
then hopefully you're buying from the U.S.
I mean, you're doing it because you're incentivized to do it.
Right.
You're no longer wondering what people are going to do because fear and greed. You're greedy. You want to make more money on the house that you're building or the property that you're developing. And there's no incentive to buy from China because you have to pay all of the tariffs and you're getting it all the way from point A to point B, you're going to do the easier and the cheaper thing, which is to buy in America. So I think that...
Well, also, you were talking about how specific areas like multifamily were a good asset class. That also I saw was manufacturing was one of the other major asset classes that were like booming from what's going on.
Correct. And what ends up happening, in my opinion, is if you do have a high tariff environment and say you're buying, like I was talking to the guy that did our floors the other day. He was like, man, I buy a pallet of these floors from China. And if Donald Trump wins, it's going to ruin my business.
Right.
And he's probably right. It very well could ruin his business because now he's going to have to spend a lot more money on quality. It's going to increase the cost for consumers wanting to buy it, and it might reduce sales.
Right. Because now he's not as competitive as he was.
He's not as competitive. So people are going to have to pay more money. And that's how the inflation gets driven in from tariffs. Now, that's a reality. So if we're going to buy 400 unit property and we're going to spend $7 million on CapEx work, and that's what it was.
Can you explain what that is?
Capital expenditures like renovating the apartments and creating more value for the people living on site.
Okay, perfect.
So they're willing to pay a premium and a higher rent because now it's a 90s property that feels like a 2020 property.
Yeah.
If that $7 million budget is now half of what's needed, then that extra $7 million has to be put into the total capital stack of the property, and that's going to reduce people's returns.
Yeah.
So these will all have effects. But like I said, if you have that kind of inflationary environment and it does affect you on your CapEx budget and it does affect you on all of these other things, it's usually going to correlate to also having higher rents.
Yeah. I think as we wrap up the episode, I'd like us to offer some type of advice to our listeners. So I'd like to ask you, what are some key strategies that investors should consider for the year ahead?
Yeah, I would say, really try to figure out in your own mind, and when you're evaluating things, don't just, turn on the TV and listen to what people are talking about, but try to figure out what's driving the momentum in that space. You're really trying to play chess, not checkers. So, you don't want to just immediately react. If you believe in a company's fundamentals, say there's a handful of companies that you really believe in the fundamentals, and they're either doing really well right now, they're doing really poorly right now. Don't be scared to purchase more of those shares if you think the company is doing really well and you think it's going to do well and the potential to do well in the future. Try to find some of the companies that you think that, given deregulation and a thriving and policy change, what companies are going to be a beneficiary of that, and maybe take a small test amount of capital and put it towards there. When it comes to real estate, whether you're active or you're passive, I still think that you're in a buying opportunity. If you're sitting on a home and you have a 2.5% mortgage, don't refinance it.
Yeah.
Don't buy that new house that is calling your name down the street.
That's where we are. We're like, you know what? We bought at the best time and we're gonna just stick it out and see. And maybe this just becomes an investment property for us later down the road.
Right. And that's what I would kind of propose to people. But at the same time, if you're somebody that actively buys real estate that cash flows, just because you have a high interest rate, if that property cash flows and you can get the rents or the income from that property, chances are that if you wait until interest rates are low, you're going to pay 30% more for the property.
Yeah, because the competition's going to be there.
So don't, analysis by paralysis. Figure out what you're doing. Try to make sure that you're limiting your risk. And then, one of the big things that you do in a time when values are falling because of high borrowing costs is, and Viking has employed this strategy, is it's a flight to quality. Go after some of those assets that if rates were really low would be unattainable, newer properties, things that have less deferred maintenance, things that are easier to manage. When you get to that sales opportunity, you're really going to be able to capitalize on the exits.
Awesome. Well, you actually gave me the best transition because our next episode that we have will be discussing building a better portfolio. So we'll be talking about both active and passive investments, stocks, risk tolerance. We're going to really cover the gamut of what it means to build a portfolio and kind of some strategies and tips, things that we've learned in our personal life, professional life, and through everything that we've done. And, unless you have something else to say, I think that this was an incredible episode. I'm grateful for your time.
Yeah, no, thanks so much. I'm excited for the next one.
Awesome. Thank you all for joining us. We look forward to seeing you next time. Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.